Imagine this. In the dead of night, as trading floors across New York flicker with desperate algorithms, a $390 billion bomb detonates in the heart of the global financial system. Bullion banks, those titans of Wall Street who've gambled everything on keeping silver suppressed, watch in horror as their massive short positions unravel, forcing margin calls that cascade like dominoes through the economy. It's not just a market correction, it's a full-scale apocalypse, echoing the 2008 crash, but amplified by a commodity no one saw coming. Trillions in derivatives ignite, banks teeter on insolvency, and everyday investors wake to frozen accounts and evaporating wealth. This isn't speculation, it's the inevitable explosion we've been hurtling toward for the last 72 hours. But how did we get here? Stick around, because the full story, the manipulations, the hidden players, and the escape routes is about to unfold, and what you'll learn could shield you from the fallout or position you to thrive in the chaos. The stage was set just days ago on January 14th, 2026, when silver shattered records, surging to an all-time high of 92.23 per ounce amid a frenzy of buying that no one could ignore. Industrial giants in solar and electric vehicles, sovereign funds quietly stockpiling, and retail investors finally awakening to the metal's scarcity, all converged in a perfect storm. Yet, beneath the surface, something darker lurked. Bullion banks, the shadowy architects of the commodities world, had built empires on shorting silver, betting billions that prices would stay low forever. Their positions? A staggering 4.4 billion ounces short, equivalent to over 5 years of global mining output at current rates. At $90 an ounce, that liability balloons to $390 billion, a number that dwarfs the market caps of some of the world's largest financial institutions. These aren't abstract figures. They're the ticking explosives wired into balance sheets from JP Morgan to Citigroup, entities that have long manipulated futures markets to their advantage. As the price climbed, whispers of panic rippled through trading desks. Margin requirements spiked. CME Group hiked them by 15% in a bid to cool the rally. But it only fueled the fire, forcing weaker hands to liquidate while the big players doubled down. By the early hours of January 15th, the battle intensified. Silver didn't just dip, it plunged in an orchestrated smash, dropping from $92 to $86.20 in mere minutes during thin Asian trading liquidity. Mainstream headlines screamed crash and bubble burst, painting a picture of overzealous speculators fleeing the scene. But dig deeper, and the truth emerges. This wasn't organic selling. High-frequency algorithms, deployed by the very banks defending their shorts, flooded the Globex market with paper contracts, promises of silver they never intended to deliver. It's a tactic honed over decades, creating illusory supply to overwhelm real demand. Yet, this time the market fought back with unprecedented ferocity. Within hours, prices ripped back to $91.50, a V-shaped recovery that stunned observers. Why? Because underneath the digital chaos, physical reality asserted itself. Industrial buyers in China and beyond, needing silver for AI chips and solar panels, stepped in at the lows, creating a floor of unyielding demand. Sovereign wealth funds, sensing the vulnerability in Western vaults, accelerated their acquisitions. The bounce wasn't luck, it was physics. The deeper the suppression, the harder the snapback. As the sun rose on Wall Street that same day, the narrative shifted. Reports trickled in from the Shanghai Futures Exchange, where regulators clamped down on high-frequency trading and slashed position limits, cooling mainland futures that had propelled global prices skyward. Silver slipped again, down as much as 5.1%, but the move reeked of coordination. Chinese authorities, holding the world's largest refining capacity, had already banned silver exports on January 1st, tightening the noose on Western supplies. This wasn't mere policy, it was strategic, exacerbating a global deficit projected at 200 million ounces for 2026 alone. In New York, the COMEX futures told one story, a volatile dance around $88, but Shanghai painted another, premiums soaring to $13 over spot, with physical trades hitting $99.69. Arbitrageurs, those silent movers of metal, mobilized pallets from London and New York vaults eastward, draining inventories at a rate that alarmed regulators. LBMA stocks plummeted, with 1.3 million ounces vanishing from JP Morgan's holdings in a single day. The spread wasn't a glitch, it was a lie detector, exposing the paper price as a manipulated facade, while the real metal flowed to where demand was inelastic and insatiable. The pressure mounted into the afternoon of January 15th, as options expiry loomed like a guillotine. Banks laden with call options, struck at $92, faced catastrophic losses if the price settled above that line. Their desperation manifested in a double-tap attack. Another wave of selling hammered silver to 87, aiming to shatter bull psychology. Media amplified the fear, with outlets like Reuters and Forex.com declaring the rally's end, citing profit-taking and tariff pauses. But social platforms buzzed with dissent. Traders on X, formerly Twitter, labeled it a surgical strike, sharing charts of backwardation where spot prices eclipsed futures, a rare signal of immediate scarcity. Lease rates for physical silver skyrocketed, making borrowing the metal prohibitively expensive. One viral thread from a macro veteran claimed, "This hasn't happened before. 4.4 billion ounces short against 800 million mined annually. If silver rises, banks collapse." The math checked out. At $90, the short's liability neared $390 billion, a sum that could trigger systemic contagion, forcing central banks to intervene or watch the dollar's hegemony crumble. By evening, the resilience became undeniable. Silver clawed back to $90.30, defying the assaults and establishing a new base amid the wreckage. This wasn't retail frenzy, it was institutional might. Entities like Trafigura and Chinese state banks exploited the arbitrage, buying cheap paper in New York and shipping physical to Shanghai for instant 15% profits. The irony stung. While U.S. policymakers convened G7 talks on securing critical minerals, their own systems banks subsidized exports to geopolitical rivals. Venezuela's silver reserves entered the fray, with unconfirmed reports of U.S. military moves to secure them as a bailout for exposed institutions. Insurance policies from Lloyd's of London, expiring January 31st, added urgency. If banks couldn't prove physical holdings, coverage vanished, inviting insolvency. Open interest data revealed the forensics. Despite the drops, positions rose, meaning every sold contract was absorbed by longs intent on delivery. The banks weren't just fighting buyers, they were battling math, physics, and a shifting global order. As January 16th dawned, the volatility persisted, with silver dipping to $86.84 before stabilizing around $88.67 by mid-morning New York time. Kitco charts captured the whipsaw, a $6 range in hours, echoing the 2008 volatility, but tied to a tangible asset in short supply. CME data showed open interest climbing for the March 2026 contract, defying typical crash patterns where longs liquidate. Instead, it signaled a squeeze accelerating, traders rolling backward, preferring near-term delivery over future promises. Bullion banks like TD Securities felt the burn, closing shorts at losses exceeding $600,000 in a week, their second hit since October. Historical echoes resounded. 8 banks had paid $1.3 billion in fines for silver manipulation from 2016 to 2025. Yet the game continued. Now, with prices up 29% year-to-date and deficits widening, the suppression machine groaned under its own weight. X threads exploded with warnings. Force majeure incoming, vault exodus alert, as dealers quoted premiums hitting $120 for physical bars, disconnecting from the screen price. This escalating drama forces an uncomfortable question. Are we witnessing the prelude to a 2008-level crash, or something far worse? The bank's shorts aren't isolated bets. They're intertwined with derivatives worth trillions, hedging everything from currencies to equities. If silver breaches $92 decisively, and the bounces suggest it will, the gamma squeeze ignites. Option dealers, forced to buy futures to hedge, amplify the upward spiral. Margin calls cascade, liquidity dries up, and suddenly the interconnected web of global finance frays. Central banks, already protesting U.S. policies under the new administration, might accelerate diversification into hard assets, further pressuring the dollar. Geopolitical tensions amplify the risk. China's export ban isn't altruism. It's a play for dominance in critical minerals, leaving the West scrambling. Venezuela's raids tie into this, potentially a covert operation to repatriate metal and shore up bank vaults before the insurance deadline. The midpoint revelation hits hard. What if the crash nightmare isn't hyperbole, but a calculated outcome of decades of unchecked leverage? Reframing the narrative, consider this twist. The volatility isn't chaos, it's the death throes of a broken system. For years, banks profited from naked shorts, selling promises without backing, confident in their ability to roll positions indefinitely. But 2026's industrial boom, AI demanding silver for chips, EVs for batteries, solar for panels, has made demand structural, not cyclical. The Silver Institute's forecasts, once dismissed, now haunt. Supply stable at 800 million ounces. Demand declining slightly, but still outpacing by hundreds of millions. And recycling's halt at high prices, and the deficit becomes a chasm. Backwardation, once rare, is now chronic, with spot overtaking futures, as buyers refuse delays. Social reactions on X underscore the shift. Threads from veterans like No Limit Gains warn of balance sheet extinction, their analyses going viral with millions of views. This isn't 2008's housing bubble built on illusions. It's a commodity crunch, grounded in atoms, not algorithms. The uncomfortable truth? Banks aren't victims. They're architects, now trapped by their own hubris, forcing governments into desperate measures that could ignite broader conflicts. Tension builds as we approach the climax. Options expiry. This week removes the boot from the market's neck, unleashing stored energy like a coiled spring. Shanghai's $130 trades mock New York's $88. The $15 premium a gravitational force pulling prices eastward. Arbitrage vacuums suck vaults dry, with LBMA reports confirming accelerated outflows. Force majeure alerts circulate. miners declaring inability to deliver, wholesalers freezing markets amid borrowing rate spikes. TD's repeated losses aren't anomalies, they're harbingers. As banks like Bank of America and Citi face similar reckonings, the $390 billion short detonates here. When the first major player taps out, declaring inability to cover, the chain reaction begins. Prices don't grind higher, they gap, potentially to $150 overnight as shorts scramble. This triggers the nightmare. Bank insolvencies cascade, credit markets seize, equities plunge in sympathy. The 2008 parallel? Bailouts saved the system then, but now with silver as the fuse, public outrage might block rescues, letting the paper empire burn. In the aftermath, as silver stabilizes at triple digits, the world transforms. Pricing power shifts irrevocably from west to east, Shanghai dictating terms while New York becomes a sideshow. The dollar's privilege erodes, inflation expectations unbound by suppressed metals. Investors who held physical emerge empowered, their stacks now fortresses against fiat fragility. Yet the cost is profound. Disrupted supply chains halt tech revolutions, geopolitical rifts deepen, and everyday lives feel the ripple of empty shelves and higher costs. This apocalypse wasn't inevitable, but engineered. Decades of manipulation culminating in a reckoning. As the dust settles, remember, volatility was the signal, not the noise. It heralded the greatest wealth transfer, from paper tigers to those anchored in reality. You've journeyed through the battle, the deceptions, the brink. Now, armed with this knowledge, what will you do? The metal speaks, the system fractures. Hold fast, for the real war is just beginning.